Today feels heavier than normal. Oh my, I feel much lighter. In the last several years, the internet has been inundated with articles and videos about passive income. Unlike this video. Do you want to learn how to make millions of dollars while you're sleeping? Well, let me show you how with this one crazy fishing trick I learned when I was fishing for piranhas in the Amazon. We're gonna focus on building one of the simplest forms of passive income there is, dividend investing. What it is and how it works is coming up. So hit that like button and let's get started. Things are getting serious, slaves are coming up. Hello there, my name is Caleb and my goal is to teach you financially what you may have not been taught in school. I'm truly honored that you're here. Let's break down stock investing into two categories. There are stocks that have dividends and stocks that don't. Dividend stocks pay you a percentage of annual income based on the amount of stock you own in a specific company. This is in addition to the growth in the value of the stocks. Other companies do not provide dividend earnings. Let's look at an example. Apple, one of my favorite companies, much to the chagrin of many of my engineering coworkers, pays out a dividend of 0.67% annually according to Google's most recent dividend yield stat. If you go to their investing information on Apple's website, you can see exactly how much they paid out per quarter in dividend earnings to their shareholders. They paid anywhere from 77 cents to 82 cents per quarter per share in 2020, at least until they did the 4-to-1 stock split in August. So overall, you could expect to receive $2.62 in dividend payout per share of Apple stock that you owned last year. Now that's in addition to the 81% increase in stock price that Apple saw in 2020. Obviously, not every year is going to be like 2020 was for Apple, but the benefit of dividends is that you get paid regardless of the status of the stock market. It's not a guarantee, but there's a better chance of getting paid even if the stock drops in price. Through the 2008 crisis, Apple wasn't paying dividends to their shareholders. Walmart, on the other hand, has increased their annual dividend yield to their shareholders every year since 1974. It's 20 years before I was born. That's 46 years straight of annual dividend yield earnings increase. Wow, that's a mouthful. Very impressive. Now, before we get into the benefits of dividend stock companies, we gotta thank our sponsor, Haircuts. Hi, I'm Caleb, and it's been 4 months and 2 days since I had my last haircut. A haircut really changes you. I feel more free, the weight doesn't do as much damage to my knees. It takes like no time to wash my hair or dry it. Better on my neck, because I don't have to swipe my head as much to get my hair out of my face. It just makes you want to echo that old hymn, Amazing Grace. I was blind, but now I see. Thank you, scissors, and thank you, Haircuts. The benefits of stock dividend companies are a couple-fold. For one, as I mentioned before, you can get returns from the company, not just from the dividends that they pay out, but from the growth of the stock. Two, companies that pay dividends to their shareholders tend to be a little bit more conservative financially in how they run their business. If they promise a specific dividend yield, they must maintain large cash reserves in order to pay their shareholders annually or quarterly. Also, because they pay their shareholders, they must take fiscal responsibility more seriously to ensure that any decisions that they make won't risk their ability to pay dividends when the time comes. Which means that dividend stocks tend to be for larger companies that are a bit more predictable in their growth. There are a couple things that you can do when you're paid dividends. You can receive the dividends in cash and use the money as you so choose, or you can reinvest it into the company. US News and World Report said this: from 1970 through 2019, 78% of the total return of the index can be attributed to the reinvested dividends. $10,000 invested in the S&P 500 in 1970 with dividends reinvested would have grown to $1,636,370 by 2019. When disregarding dividends and only considering price appreciation, the $10,000 initial investment in the index increases to just $350,144. Clearly, reinvesting dividends can have a huge impact on your wealth. Now, I have good news. Yes, you can invest in stock dividend companies through any brokerage like Robinhood. Now, personally, I don't tend to invest in single stocks because of their relative volatility compared to the rest of the stock market. So if you're like me, you can still reap the benefits of dividends by investing in broader range mutual funds and ETFs. I found this out in an incredibly pleasant way last December. I was checking out my 401k to see what kind of growth it had seen that month, And lo and behold, within the growth section, it said dividends and interest, $914. Now this is dividends and interest, which includes the interest earned by the bonds within my blended portfolio. But regardless, that is a nice boost to the 401k. So I want others to understand how crazy dividends can be within the wealth building equation. And so I'll pass this question on to you. Are you invested in any dividend stocks? Would you do it now? Did you even know that these existed? I'd love to hear from you in the comments down below. And if you would, please hit the like button, subscribe subscribe button and notification bell to give YouTube the old thumbs up on sharing this video with others. And remember, money doesn't have to be confusing. You can control it. Now I'm off to enjoy a week of not having to work on my taxes because I finally got them together for the CPA this weekend.